When you look at Brexit, and when you look at worst case scenario, which is crashing out, is this like a concoction of hell, actually, for a central bank? Because you can see inflation ramp up, and so you have to increase interest rates right at a time where actually the UK consumer has no savings.
Right, I think it really depends on what kind of Brexit outcome we get. But in your scenario, in a no-deal scenario, things could complicate quite a bit. So far, the Bank of England has concluded that Brexit has an impact on the supply side of the economy. And so when potential growth slows, the impact could be inflationary, and that's why they are in a process of a gradual normalization of interest rates. But under the assumption of an impact that has to do with uncertainty, with falling sentiment that affects business investment to a greater degree, it's not necessarily obvious that the same monetary policy course will happen.
Bob, when you're in London, I mean, how much time do you spend actually trying to figure out the politics, and how much time do you try to figure out, Mark Carney's next move?
Try to figure out a lot of those things. I think he's got an unsolvable riddle. We don't talk much about the currency, but if sterling drops off quite a bit, then of course he's got to raise interest rates, and of course that's going to be bad for the housing market and the rest of the economy. But what else is he supposed to do?
Daniele, what are the incentives that Europe has to drive forward this debate or discussion, or do they just maintain as a reactive mechanism to all that's going on within the United Kingdom?
Well, I think there is an element of incentive and disincentive at the same time. The European agenda is much more complex than that, but there are pressing deadlines approaching. To the extent that there is an agreement, however partial, in November, I think then they could move to the next phase. But it's equally possible that given the complexities of the many aspects that need to be addressed, this drags somewhat longer, and our call is for the UK economy to slow in the second half of this year.
I mean, within that and within the more cautious Morgan Stanley view, there's the idea of a timeline. What is your timeline to where Brexit actually happens?
To a Brexit agreement?
Yes.
I think some possibility that some preliminary agreement may happen later in the year, in the fourth quarter, for example, in November. But again, it's not necessarily obvious that that happens. And if not, then it will come pretty close to the all-important deadline early next year.
I mean, Bob, it seems that there's a national obsession with Brexit, and rightly so. But do the rest of the world care about it? At first, when the Brexit vote happened, we kind of thought actually it could force also, this region into a recession. Do you see outlasting effects, even if we have a difficult Brexit?
No, it's strange to me how Brexit has faded from the focus of a lot of global investors. I think a lot of investors, and ourselves are included, are looking at Europe, and Europe's in a pretty good spot right now. It could take a hard line on Brexit and focus on negotiating some sort of trade agreement with the U.S., and if that falls through and the U.S. and China get in a trade war, then why not renegotiate a trade agreement with China? So Europe has a lot of options ahead of itself.
All right, Bob, thank you so much. Bob Michael there of JPMorgan Asset Management, Daniele Antonucci of Morgan Stanley.